us a great deal. Another thing we see is commingling of assets, what we call active assets and non-active assets. These are just a few of the things we're intending to talk about today. We're also going to be discussing about things that oftentimes are not performed. So this is a clarion call to all of you out there who haven't done an estate freeze, because we maintain that there's a lot of misconceptions about estate freezes. You've heard our consortium speak at length about what estate freezes are and what they achieve. Well, we've talked about the fact that at death, our assets are deemed to be disposed of, and it results in significant tax, or can, where there's a capital gain. And estate freeze can prevent a lot of unnecessary tax. We also talk about things like corporate purification, where we're still seeing across Canada and all jurisdictions that we're involved with a failure to perform certain very essential purification issues. We've also seen issues involving lack of asset protection. And candidly, if you have a corporation, maybe a holding company, and you have a spider web of companies underneath, who knows, or maybe you simply have an operating company, or 2 or 3 of them, well, your assets are quite vulnerable. And that is, if there were a litigious situation, you could lose your shares of your company if you don't have proper planning done. And if you haven't used a trust. A trust or another one. Often we see people that are really reluctant to undertake something that they don't understand. And part of the reason that we do this kind of programming is in order to help companies to understand that. We'll also be talking about capital dividend accounts today. Well, what are capital dividend accounts? Well, all of you who are accountants undoubtedly know that, but business owners have awareness of it too. But they're very, very important, because capital dividends represent the capability for you to distribute assets from your corporation or cash from your corporation without the need to pay tax. So it's a pretty important issue. And we often see situations where CDA is not utilized. CDA, capital dividend account, occurs for a few reasons. One could be the sale of a capital property, maybe real estate, could be the payment of a life insurance policy. Losses that you have in the future, capital losses, can have the effect of eroding capital dividends accounts. And therefore, it's important to use them. So if you have a CDA account available, if you have liquidity available, or if you have commingled assets, you should perhaps think about how you can resolve those issues, because failure to plan is the most expensive thing. Some people will say, well, what does it cost to do an estate freeze? How much does it cost to set up a trust? Well, a lot of these things are rather insignificant compared to the cost of doing nothing. So without further ado, I'd like to make an introduction to our expert panel. We have a very distinguished panel, as always. Quantum Business Law always seeks to bring together some of the top people in law and finance from across Canada and internationally. Today, we have a rather small panel, which gives us an opportunity to be all involved in a collective, collaborative discussion. I'd like to, first of all, introduce special guest Diane Everette. Diane is a tax lawyer who's recognized across Canada and elsewhere as being an expert in various different areas of tax, in particular with an emphasis of financial services. Diane has a wealth of experience, has lectured extensively to bar associations and other groups, accounting associations. Lorne Saltman, who you're aware of from previous programs and probably elsewhere. Lorne is also recognized internationally. Lorne has also lectured to the bar associations and various different accounting groups, spent a lot of his career in education. John McLeod. John is an internationally recognized expert in the area of fiduciary services and financial industry. John has been a key executive internationally with the Royal Bank of Canada, as well as Forvest family offices and a number of different groups. I should mention, by the way, that Diane is with quite an impressive financial services group called PPI, who is essentially a group that provides a wholesale distribution of financial services products, including insurances that are often designed to create asset protection, intergenerational wealth, funding of capital gains taxes, and other tax benefits. So without further ado, we'd like to kick this off. And we're going to talk to you about some really critical things today. I've mentioned a few issues that I believe is of significance, and we're going to go through some of these things one at a time. Well, the first thing is we intend to keep this program to 1 hour. It's always our policy to finish on time. We've got a situation here that reflects some of the things that I've been describing. And in this slide, as you can see, there's a few issues that we have with this company. This generally common structure. And maybe I would invite our expert panel to talk a little bit about this, but we'll deal with one at a time. First thing we've done is we have essentially commingled real estate assets and active assets under a single holding company. Maybe I'd call on Lorne Saltman as a beginning to talk about the effects of commingling a real estate company which holds active real estate, perhaps not, an OpCo and a USCo, all under one corporation. And in this case, we're presuming there's no estate freeze. This is all common shares that are held by the holding company. We're seeing this across Canada. Lorne, maybe give us an idea of what you see with that issue of commingling these different entities.
Okay, thanks, Todd. I'll start with this kind of structure apparently looks pretty good because you're dividing up the businesses in different entities to provide some asset protection. But if you're forward thinking and trying to contemplate a future sale or disposition through death or departure from Canada, what you want to do is to be able to make sure that the shares that are disposed of, in this case, it would be the entrepreneur shares of Holdco, are qualified small business corporation shares to entitle the entrepreneur at least himself or herself to the lifetime capital gains exemption, which this year is about $892,000 and increasing by the CPI each year. And if we look at the various companies, we have to be very careful about the strict tests that apply in the case of qualified small business corporation shares. And I won't go into tremendous detail. I'll just point out that each company has to meet a 90% test when you've got a holdco owning an operating company. Now, in other words, the fair market value of the shares is derived 90% or more from active business assets used in carrying on a business in Canada. If RealCo, for example, only had real estate assets used in carrying on the OpCo business, such as a factory that's leased to OpCo, that would be fine. But by mixing in real estate investments in the same company, we taint RealCo. And we have to think about USCo because that's not a Canadian asset. The shares of USCo could again taint the qualification of the holdco shares in the entrepreneur's hands. So what we are looking at is a tainted structure that doesn't give us the maximum ability to claim the lifetime capital gains exemption. Plus, of course, with the entrepreneur looking at a growing value in connection with the real estate, the OpCo, the USCo, there's estate freezing is missing. It would be a lot more effective to protect assets and defer capital gains tax if we did a freeze at the level of entrepreneur shares in Holdco. So those are some of the key points, Todd.
No, that's great.
Just to supplement what Lorne said, it would appear, looking at the chart here, that the assets include surplus cash, personal use real estate, passive investments, and insurance with cash value. So it immediately blows up the 90% test right out of the water, and would suggest some form of purification needs to be put in place, particularly if you wanted to collect lifetime capital gains exemptions for mom and dad and other shareholders and adult children and whomever else.
How true, John. I'm going to say that this is, something that continues to be one of the most overlooked things. We're talking about two things. We're talking about where action can be taken and perhaps is not, such as an estate freeze. Then we're talking about where a situation can be resolved but might be overlooked. So I think that in general, one of the things that's always prudent to do is to ask yourself a question. are the assets a mandatory precedent to trade? That's what, in other words, can you run your business without them? So, but if you have, say a life insurance policy with significant cash surrender value, or you have, say, a real estate property there, well, it's quite unlikely that you'd be able to defend that to CRA. I hope everybody's grasping what we're talking about. Essentially, in order for the shares of the company to be qualified for the lifetime capital gains exemption, 90% of the assets have to be actively used in the business at the time of sale. That's what Lorne had mentioned. And for 24 months, typically 50%. So the test is a fairly stringent one. And when you have stacked companies, and we've talked about this before, well, this threshold rises. In other words, if it's your intention to claim a capital gains exemption, the anti-stacking rules cause this to be a test of 90% for a full 24 months. So we've been talking about these issues for a long time. And here's the manifestation that we're seeing when we get calls from lawyers and accountants, and we meet with some of the business owners that have been referred to us or that have come to us through the program. And they're saying, well, don't you need cash to run your company? Well, sure you do. And what is a mandatory precedent to trade? Would one of our columnists like to comment on the definition of what might be a reasonable amount? What is a mandatory precedent to trade? What circumstances would allow a company to carry more cash and possibly defend it? I'm going to say, if you go by the letter of the law, it's 90%. One could always argue, well, there's certain covenants or requirements or something that may be in place that may require more of that. So these are some of the problems we're seeing. Then we have a loan. Who would like to comment on the loan? We have a loan of $1 million that's been paid to the entrepreneur. Accountant says, well, that's fine because we're paying market value interest. Is that okay? Is it okay to keep a loan on the books of a company to a shareholder after 1 year if you're paying interest? Any comments from our columnists? Or sorry, our panelists.
Let me take a shot at that.
Please.
So anytime that property of a company is made available to a shareholder, you run the risk of having that treated as a benefit, a taxable benefit. And if there's a taxable benefit, you're taxed on it at full income rate. You don't get any dividend tax credit, and the company doesn't get a deduction. So you've got a double whammy.
Yep.
If it's a loan, there's a special rule in the Income Tax Act that says this will not be treated as a shareholder loan or a shareholder benefit, rather, so long as you repay the loan within 1 year after the year in which the corporation made the loan to you. Now, I have seen people before say, okay, well, I'll just repay the loan and then I'll issue a new loan. Well, the Department of Finance and the Canada Revenue Agency have been on to that game for many, many years. And so if you have a series of loans that are designed to repay within the 1 year, followed by another loan, followed by a repayment, you're going to get caught and you're going to be under the benefit provision. So it's one and done. So the $1 million loan, let's say the company's year end is, take an example, July 31st of 2021. So we make the loan this year. That loan has to be paid by July 31 of 2022. If you don't, then you as the entrepreneur shareholder are going to have a taxable income inclusion in 2022 for $1 million. And Holdco is not going to have a deduction.
Yeah.
So
this is
double whammy.
This is a wake up here. So we're suggesting, well, my answer could be, well, depends. There are some narrow exclusions in 15.2 that we may be able to depend upon, but they're very, very narrow. In general, it's very risky business, and any loans should be paid within 1 year as a general rule. There's a few things we're going to talk about before we talk about solutions. You see in Realco, we have active and non-active assets. We're seeing a lot of situations where the capital gains exemption on Realco is being ignored. Well, where you're commingling active and non-active assets inside of a single corporation, you're tainting the shares of that corporation. But moreover, the bigger problem that you have here is that the Holdco would have to be pure. In other words, the shares of the Holdco would have to be qualified. for the capital gains exemptions, and we have things underneath of it that are tainting it. That would depend, of course, because other planning may be done that would have the effect of doing estate freezes at the RealCo, OpCo or level, and so on. The US Co is going to be a problem since the assets must be active in Canada. Another issue is if you have US vacation property, there's ways that you can insulate against the effects of estate taxes. Cottages in Canada, there's certain type of not-for-profit corporations that can be used that can have the effect of avoiding capital gains taxes on cottages. So we're saying that there's a lot of solutions as we navigate this difficult terrain. Now we'll get into just some general planning, and maybe I'd have call on John McLeod for a moment, if I might. John, what kinds of risks do you think are eliminated by the use of a trust when it comes to asset protection and vulnerability to litigation? How does a trust, and you've defined trusts in the past for our group, and we found that your explanations have been extraordinary, but how, in real simple terms, does the use of a trust, create asset protection that wouldn't be available if there was direct ownership in shares?
Well, for 1,000 years, people have considered the use of a trust as an asset protection vehicle. But what's most important here is you put down foreign trust versus a domestic trust. And I think that the Supreme Court of Canada, in one or more cases, has rendered Canada as not a particularly strong asset protection jurisdiction. In other words, Canada has become a bit of a creditor-friendly jurisdiction. And in most jurisdictions, in order to achieve asset protection, you have to be solvent. When you transfer to the transfer can't render you insolvent. The trust proceeds can't be the proceeds of crime, and in any files that we deal with, it's likely that that's not going to be the case. And finally, and most important, the transfer can't be a fraudulent conveyance, which in most jurisdictions means a transfer to an existing and known creditor. However, the Ontario Wine Vaults case at the Supreme Court, I believe it was, said that not only does the creditor have to be an existing and known, but a creditor should reasonably be able to believe that any assets that you had at one point prior to the transfer would be available to such creditors. And therefore, it has the ability to set aside the situation. So asset protection is in an increasingly litigious global world, because most of our clients now aren't just Canadians doing business in Canada. There's an international component to their business, either inbound or outbound or a combination. And therefore, the use of a 900-year-old structure like a trust is still very valid, but one tends to think about selecting an asset protection jurisdiction with good jurisprudence, good court system, and that's in a well-recognized common law jurisdiction.
Let's fully develop this. So what we're talking about is doing an estate freeze. And in a moment, I'll ask Diane to describe the benefits of doing an estate freeze. But before we call on Diane to do that, I'll say that we do an estate freeze having the effect of freezing or capping or limiting the value of those shares that the entrepreneur has, both at the OpCo and the RealCo level. And then what we're doing is we're setting up, issuing new common shares, having a trust subscribe for new common shares that start out with a nominal value, but reasonably speaking, all of the future value of the real estate, which may grow exponentially, and the corporation, which may do the same, would go to the trust. So John, just if say as an example that the entrepreneur was to be sued. Now, keeping in mind that we're not sending a penny to Barbados or St. Lucia or Cayman or any other jurisdiction that we might recommend the use of a trust for. But if an individual in Canada was to be sued, and say there was a court order from say a provincial court in one of the many different jurisdictions in Canada, what effect would it have? And say they arrived in Barbados and they wanted to have this order enforced because of reciprocal enforcement between the different Commonwealth jurisdictions. What's going to happen, John? Most likely.
Well, I think that, and we'll get Lorne to comment on this after the fact, but that the Barbados court may say, well, look, I recognize your judgment and so on, but the underlying asset is held in a Canadian corporation or in a Canadian investment account or a Canadian something or other over which we don't have jurisdiction. Lorne, what is your view on how you feel the judgment will be treated?
A couple of comments. One is the trust is a discretionary trust, which means that no beneficiary has a fixed entitlement. All of the interest the beneficiary has is contingent, depends on the trustee exercising its discretion. So if there were a creditor who could be an outside business creditor or an inside family member, let's say in a matrimonial dispute, suing the beneficiary could defend the suit by saying, I don't have anything of value in this trust because the trustee may give everything to the other beneficiaries. That's the first line of defense. And the second is, we choose an offshore jurisdiction, a Barbados, a Cayman, a Bermuda, where the laws are similar. They do not have the Fraudulent Conveyances Act, but they prevent fraud. But so long as the trust is validly set up, each jurisdiction has its own limitation period. The Bahamas is 2 years, Barbados is 3 years, etc. But it means that the court will not entertain a claim against the trust, even if it were an accusation of fraud, if the limitation period has run out. And the final comment, just to supplement what John said, if a foreign judgment in a civil matter, such as, let's say, a family law court in Ontario giving an order for an equalization payment, and the spouse who feels wronged tries to take that order from Ontario to the foreign jurisdiction to have it enforced, even though many of these jurisdictions have what are called reciprocal enforcement of judgment legislation, which means that they give due credit to other Commonwealth courts. In this case, as John has mentioned, a Barbados court will say that their jurisdiction is limited and that while the judgment may be enforceable in Ontario against Ontario assets, it is not enforceable in Barbados because the Barbados courts only have jurisdiction over Barbados assets. And in our typical estate freeze, the Barbados Trust owns shares of Canadian companies. And the final point I'll make here is, in all of this estate planning and estate freezing, please keep in mind that the assets we're dealing with are the shares owned by the entrepreneur, then by family members or a trust for the family. We are not trying to take assets offshore from any of the operating or investment companies. Every asset remains in Canada. We are only dealing with the shares owned by the family members at the top. Todd, back to you.
Well, thank you.
Just to add to that, however, one of the uses of a trust is many of our clients might have a property in the United States or the United Kingdom or some other place where there is an estate tax of 40% or something like that, and they don't particularly want to enjoy the foreign estate tax. So having the assets held in an entity that isn't determinate at their death, it would be useful. And so often we'll have the trust either directly or indirectly own foreign property in other jurisdictions.
Excellent. Al, good points. Diane,
John, I'd suggest to you that with HR 1 in the States right now, and the Biden administration actively considering changes to the estate tax rates, you know what, that argument that you're making gains all the more traction, I believe.
yeah, I think that's true, Diane. When we look at various different solutions, we do planning. Well, sometimes these things are just overlooked. They're sometimes generally assets that are held personally. Interestingly, there can be transfer of real property in states that does not trigger taxes depending upon the situation. Land transfer taxes can apply in some jurisdictions. And as an example, in the state of Florida, providing that there's no mortgage on a property, land transfer taxes don't apply. So if we're considering moving property into an entity, perhaps a trust or a limited partnership, there's ways that we can insulate against this very high tax, as high as 40% in the US. Also, I'd say that, allowing things just to continue and not focusing on it can cause other types of issues too that John's mentioned and Lorne's mentioned. As an example, disgruntled family members who sue mother and father-in-law, et cetera. Diane, perhaps before we go further, you could define for us, what a trust really does and what are the benefits. Sorry, not a trust, a freeze, an estate freeze. What is involved in doing an estate freeze and what are the benefits, please?
An estate freeze essentially freezes, as the name suggests, the value of a shareholder's interest in a business. Let me give you an example. We have OpCo down there, and let's just say that I owned OpCo and it was valued at $1 million. If I was to dispose of the shares of OpCo today, I'd have a tax liability in Ontario just under $270,000. On the other hand, what I'm going to do is I say, gee, this company's going to go up in value. So I'd really like to transfer it to my daughter. But if I transfer the shares to her, then what's going to happen is I'm going to pay that $270,000. There are some plans around that, but for the moment, let's just start with that as our operative assumption. So what I do instead is I take my shares and I freeze them. And there are a number of ways of doing it. I won't get into all the details, but I can freeze the value of my holding at $1 million by exchanging my $1 million of common shares for $1 million of preference shares. And they're redeemable for $1 million. But that's a rollover under the Income Tax Act, so it can be done on a tax-deferred basis. Please remember, tax-deferred. Then what I do is I have a trust, perhaps. It could be a foreign trust, Canadian trust, doesn't matter, or my daughter directly, subscribe for common shares in OpCo. So fast forward 10 years down the road, and OpCo is now worth $3 million. My shares are still worth $1 million because we froze them at $1 million. The $2 million surplus is actually then tracked over to my daughter's common shares because they're the growth shares. So what I've done is to have frozen my tax liability at $270,000 and transferred the growth value to my daughter and the tax liability in respect of that. A very common estate planning mechanism that we use. I think, I probably see, 100 to 150 of these a year, directly and indirectly. Very common.
Yeah. Although there are some people who believe that they're too young to do an estate freeze. And some of the reasons that they believe that to be so is because they're fearful that they would lose control of their company. Lorne, is that a concern that if an individual undertakes to do an estate freeze, that it would result in the loss of control of the corporation?
Well, it's a concern, all right, Todd, and we try to address it in our structures. And sometimes it can be a complex structure where we try to do the share exchange that Diane has explained, and the owner can own, let's say, two classes of shares, one with full value, fixed redemption amount, non-voting, and a separate class of voting shares with nominal value to begin with, and no growth. And in that way, the entrepreneur can exercise control, if wanted, over the operating company. And then we do our freeze and we create a structure that defers the growth and shifts the capital growth through a trust to the next generation. It's a complex structure because while we're trying to preserve voting control, We also want to be able to have dividends paid within the corporate structure tax-free. And so we can address that, but it does make it a little more complicated in terms of the intercorporate ownership.
Yeah.
It may also be important to mention that by using the trust that we have in the diagram here, we may be able to leverage the lifetime capital gains exclusion of roughly $900,000 for qualified small business shares by the number of beneficiaries in the trust versus just the founder or entrepreneur himself. And so every $900,000 of tax saving that you can pick up legitimately, I would say, is a good strategy.
Yeah. Now, one of the things that we have seen with some disappointment is we've seen some estate freezing being done without purifying a company. And that I don't think is a good situation to be in. You can spend a lot of money on doing estate freezes and so on, having the effect of perhaps capping or limiting the tax liability on death. But if you're not removing non-active assets, you may not qualify for the lifetime capital gains exemption. And as John just mentioned, you can, as he put it, multiply, or I think you mentioned leveraging the capability to be able to introduce family members through the trust, having the effect of possibly having many capital gains exemptions, all a little bit less than 900,000 and being increased year by year. So this is not a small thing. Essentially, what we're really talking about is solving several problems that we mentioned at the very beginning of the program. During our preface, we talked about things such as the capability to segregate assets. Well, we talked about removing non-active assets. This structure is what I would generally think of as a standard boilerplate purification structure. What does it mean? Well, these shares that we have that are going up from the operating company to the trust and so on, and the shares we have going to this capital co where we are maintaining our redundant assets, our surplus cash that is not needed. Well, this is a structure that allows you to be able to keep your active assets on the left while moving your non-active assets to the right. Segregation of assets, active from non-active, should be right in the structure, right in the foundation of the structure. Even before you start contemplating an estate freeze, why not give consideration to these issues? We see all sorts of other problems with structures that are being done right across Canada, such as intercorporate loans, which create another target for creditors, and other issues we see, such as, investment property. Say, as an example, that a company has a building that's 10,000 square feet and 5,000 of that square feet is rented out to a tenant. Well, that could cause a loss of the capital gains exemption. Are you considering who's occupying your real estate, even if it's your own business? Are you considering how CRA will look at this if you're applying for the capital gains exemption on your tax return? Is it conceivable they may look at this and say, well, no, you don't qualify. If your structure is a stacked structure and you have OpCo, HoldCo as an example, keep in mind that according to the letter of the law, you should only have 10% of those assets as active assets inside the company. So again, we don't like to see life insurance policies with cash surrender value stuck inside of a holding company where you hope to one day claim a capital gains exemption, nor do we like to see a cottage there, nor do we like to see condos or other assets. The thing to keep in mind when it comes to personal use property is CRA has two different methods that they can deal with assessing an individual in that situation. One could be just fair market value rent. We see it all the time. Oh, I pay rent to my corporation. I have this house or building there that I use personally, personal use, maybe vacation or otherwise, and I pay market value rent. Well, CRA can also look at it to say, what is the value of the property and what rate of return would it be expected to earn? And they could assess you for the greater of the two. So we're suggesting that for a number of reasons, please don't commingle active and non-active assets. This particular structure creates a conduit to be able to pay dividends, creating what we call connectedness, meaning that there's no tax on the dividend that's being paid from the operating company up to the capital company, having the effect of purifying the company. Sometimes we have to do what's called butterfly transactions, and this butterfly strategy sometimes is just considered too exotic, just considered too far out of reach. So we see companies go for decades with non-active assets that need to be removed, but with no method to do it. Well, it's not overly complicated to people that do it every day. So we're suggesting that you take time and look at it. Also consider your cash position, because cash, believe it or not, is considered a non-active asset if it's excessive, if it's not required. So there's two court cases. One is a Supreme Court of Canada decision. The other is a Tax Court of Canada decision, which I cited earlier. I mentioned that the requirement should be that the assets would have to be a mandatory precedent to trade. In other words, you cannot sell your goods or your services if it weren't for those assets. So please don't be keeping excessive amounts of cash and otherwise inside of your operating company or your holding company or your realco or whatever. Please remember that even though you have active real estate inside of a corporation that your business is occupying, that there is a possible capital gains exemption, or many of them, on the real property as well, on the real estate, right? So this, go ahead.
Todd, just to jump in there for a second, in this structure that we're looking at now, we're talking about a foreign trust, and the trust would have beneficiaries, which might include children and grandchildren and charities and goodness knows what else. But maybe you could comment on how you can create succession planning in the family, if that's of interest to the entrepreneur, by amending the structure, and how you would finance that tax efficient transfer of a manager. Yeah, that one right there. Perfect. Thank you.
Perfect. Okay. Thank you, John. This particular structure, I think, is we're just adding on to what we had before. And in reality, what we're really dealing with here is how to create intergenerational transfer of wealth. And this isn't intended to confuse anyone. It really is the same thing that we just looked at a moment ago. But the reality of what we're dealing with here, is we've done the estate freeze. We've kicked the can down the road one generation. We've frozen the shares of these two companies. And what we've done is we basically have parents that are considering retiring. And we also have an individual who's considering taking income from the company. And you'll notice that there's two common denominators on both sides of the screen. One of and that is life insurance. You can see that in the right side, what we've done is we have set up a life insurance policy that has been funded using after-tax corporate assets. The funds have been deposited into the insurance. There's a collateral assignment to a bank. The entrepreneur takes back a loan. Loans are not taxable as income. However, there's a benefit conferred upon this person as a shareholder under Section 15(1) of the Income Tax Act. He's utilizing a corporate asset in order to leverage this loan. Therefore, the entrepreneur would pay a guarantor fee. That's one scenario. And the second scenario we'll explain in a moment. Before we do, I'd like to call on Diane to talk a little bit about this kind of planning and how this entrepreneur could actually be the recipient of this bank loan and how the corporation would go about buying the policy. Maybe, Diane, you could elaborate on this for us.
Sure. Where the corporation has an asset like a life insurance contract, or in fact any other asset that's fungible like cash, it can assign it to a bank as collateral security for the bank to make a loan to the shareholder. So take an example. We have an insurance contract. Let's say it's $5 million to fund a buy, sell, or tax on death. It's a key person. And it has $1 million of cash value in it. That $1 million of cash value is on the corporation's balance sheet, and it's available if you assign the policy as collateral security to a lending institution for a loan to the shareholder. And you'll say, well, wait a minute, isn't that a loan to the shareholder debt that we were talking about in slide 1 at the outset? Well, it isn't. The corporation isn't making a loan to the shareholder. Rather, a third-party financial institution is making a loan to the shareholder, and the security for that the corporate asset. And you are, though, using a corporate asset. So arguably, there's some benefit in that, because you may recall when I talked about this initially, I said you enjoy the benefit of a corporate asset. And this is no different. Todd mentioned the guarantee agreement. So what we do, this is quite common planning technique, we've done this for years, is that we take our insurance contract with $1 million of cash value and we assign it as collateral security to, let's say, RBC for a loan to Todd. Todd's the shareholder. Todd will pay a guarantee fee to Capital Co for that privilege. Provided that the guarantee fee is reasonable, the CRA does not look at providing that as an asset to back the loan as a benefit, because Todd has paid for it. And the key thing is to make sure that you observe certain niceties around it. Number one, you have a guarantee agreement. Number two, you have a guarantee fee that's determinable, is determined, and is paid. And number three, it's paid in advance of making any loan advances. You have that, Todd, you don't have a shareholder benefit.
Excellent.
And that's the key thing. The second part of this is that you're going to pay interest on the loan, say to RBC, because you borrowed the funds. Well, you're on the hook for the loan. It's not like this is a never loan or an evergreen loan. You have to repay it at a point in time. In the meantime, you pay interest. That interest can be deductible if you use those funds to acquire income properties or acquire property for business purposes or for income producing purposes, or you invest it in your business. For example, Todd, you get $1 million loan from RBC based on the Capital Co life insurance contract, and you invest it in OpCo because it needs $1 million for working capital purposes. Well, that should be a business and income earning purpose that'll entitle you to deduct the interest on the loan that you have from RBC. That's very high level, but that's essentially the way it works.
So Diane, what you're describing then is multifaceted. What you're saying is we start off with funding an insurance policy using cash from a corporation in the form of retained earnings. And whether it be that there happens to be cash sitting in this Capital Co, or whether it be that these funds are transferred to the Capital Co on a tax-free basis, we're funding it from the corporation. And since it's a corporate asset, we have issues that we want to be mindful of. But essentially, what you're describing is utilization of the corporate asset in order to securitize a loan. But the loan doesn't go back to the company. It goes to the individual shareholder. Is that a problem in your view, Diane?
Well, no, I don't think it is if you pay a guarantee fee and have a proper guarantee agreement.
Right.
But I think there's one thing to keep in mind in all of this is that, and it's a really important one, you know, all of these companies often have banking covenants, and they don't want to see the retained earnings ground. So what you could do, and the balance sheet remains the same. If I put $1 million of cash from the corporation's bank account, let's be as simplistic as that, and put it into the life insurance contract, well, there's still going to be $1 million on the balance sheet. Instead of showing cash, it'll be investment in a life insurance contract.
Mhm.
The balance sheet remains the same. That's really crucial to remember that.
Yeah.
And so at the end of the day, you haven't triggered a covenant, say, under a line of credit for Capital Co or for OpCo, that kind of thing. So these are important considerations to keep in mind.
Good. All right. So what we'll do is we have
John, do you have any comment on that? You and I talked about this yesterday, John. Did you have anything you might want to add? Did I miss something?
No, I think you did it very eloquently, but what in particular I'd be interested in is looking at the use of insurance on the other side of this chart, because here I am at my advanced age, and I've done what Todd has recommended I do, and I've frozen my shares, and I've purified my company, and I'm and in my trust, I've got 6 beneficiaries, mom and dad and 4 kids or something like that. And so I've got $5.4 million of tax-free whatevers, but I've got these pesky pref shares now. And I've got my son that would like to take over the operation of the company, and I'm behind him doing that. How do if I give him the shares, I think there's a big tax bill to be paid right away. And how can we use the life insurance that we have on the other side of this thing to deal with the succession and eventually flush some benefit through the capital dividend account that Todd talked about at the very top of this webinar?
All right, that's a handful, but let me try it in one brief minute. How's that? So, what you would do is perhaps Holdco could fund a life insurance contract, probably on the parents' lives, say dad and mom, and then that could be assigned as collateral security to a bank for a loan to Junior, and Junior would buy the preference shares from the parent. And that deals with a pesky tax problem called Section 84.1, which for those of you who follow these things, Bill CO208 just passed in the House of Commons, is going to Senate for debate starting May 25. That could help us plan around this Section 84.1, which is highly troublesome on intergenerational transfer. But even if that stays in place, doing it the way I suggested, borrowing the funds against the value of the policy and buying the parent shares will help you avoid the application of Section 84.1, which you want to avoid, John, like the plague. So you say, okay, so there's this insurance contract. How's it ever paid off? So Junior borrows $5 million or $1 million, whatever the number is, and buys the parents' freeze shares for $1 million, and they're gone. Junior owns them. Well, what will happen is that on the death of whoever's insured under the policy, the loan will be paid off. But because the loan's paid off, that's a debt of Junior's that was paid off using a corporate asset. And again, we run into the shareholder benefit issue. But because in common law, and the way we set this up with guarantee agreements, what will happen is Holdco will become a creditor of Junior, and the shareholder debt rules will kick in. Those shareholder debt rules will do the following. They will allow you a year after the time that this loan is repaid within which to repay the loan. You say, but how's Junior going to get the $1 million? Well, as Todd pointed out at the beginning, the capital dividend account is what we'll use. The $5 million, for instance, will flow into Holdco, and it will create a credit to, let's assume, $5 million to its capital dividend account. When the bank processes the payment of the $1 million and repays it from the corporate-owned policy, repays Junior's loan, they will write a check to Holdco for $4 million. But the capital dividend account credit will be $5 million. Then what will happen is that the parent's estate can receive, for instance, a $1 million capital dividend, which they can then transfer to Junior, and Junior will then repay Holdco. That's one way of doing it. There are a number of other ways of doing it, but that's one way of doing it. At the end of the day, you avoid the application of the shareholder debt rules.
Oh, that's excellent, man. Thank you. Thank you.
In summary, I've got the
Excellent.
cash with which to buy the pref shares, and two, I've got the means to repay the loan without triggering this tax issue under shareholder debt.
And number three, you've got the bank financing it for you, and it's not coming out of Junior or the business, so to speak.
Right, and John, as you know, like some of the things that we've seen, well, you and I are certainly familiar with this with our past association and with a bank, is that it's not uncommon for parents to want to have their kids buy their shares. Yet the kids really don't have much in the way of assets. So this is a way of providing the liquidity needed to affect this intergenerational transfer.
That's excellent. Thank you very much for that explanation, Diane and John. I think the takeaway here is that commonly used financial instruments such as life insurance policies in some ways can be utilized in a way that an individual can leverage income, or I should say, leverage funds without it becoming taxable income. Quite interesting, particularly since the banks are often willing to wait until the death of the life insured before the loan is repaid. The tax consequences can be quite interesting. The Income Tax Act gives the insurance almost sacred status, but when you utilize insurance in the context of corporate planning and reorganization and this kind of architecture, well, something quite amazing starts to happen. So most of you who have looked at these strategies, well, it's not the same as when they're done in a silo. When you are incorporating an insurance product into thoughtful and carefully planned corporate structures such as we see here, it's a game changer. Sorry, Diane, I think you were trying to say something.
No, I was just going to point out that, you know, these are not evergreen loans. Let's be careful about that. These loans do have a term to them, and the lender has the option to renew them. This is not something where you necessarily wait until the person dies to repay it. You may have to repay it before that. But properly crafted, we can show you how these loans can work optimally, and that's why it's an effective cash flow strategy, as noted at the top of the screen.
And the banks like it because they've got a AAA rated insurance company
Absolutely.
asset, which erroneously they may think is better than other collateral that you may offer them.
Very true, John. Very true.
No. So the loans are rewritten and reviewed every year. So certainly the bank has the capability to either continue to extend loans or require repayment. But also,
I just want for those of you who are familiar, there is a case out there from the Tax Court of Canada where the loans were not done the right way, and it was troublesome for the taxpayers. I think troublesome is probably an understatement of the day. But this is nowhere near. This has real, authentic requirements for payment, as opposed to one which is, well, you know, wink, wink, nudge, nudge, you'll never have to repay it. This is not what this is about. This is very common. These have been going on, certainly in my practice. And John, you'll recall back in the day, we've been dealing with these since I think about 2002.
Yep, absolutely, yep.
So I'd like to call on Lorne Saltman to describe another strategy. The interesting thing about philanthropy is that it's becoming, and for many years has been, a popular mainstay in Canada. Canadians are said to participating in philanthropy, either gifts to charity or nonprofits, to the tune of somewhere about 80% of our population participates in this kind of planning. Lorne, I maybe ask you to talk to the audience a little bit about this strategy that can be used in order to bequeath shares that can achieve certain benefits that otherwise may not be possible.
Sure. Well, what we are really presenting here for the audience to consider is how philanthropy can work within the estate planning that we've talked about. There are many families that have grown assets, been very successful, and want to put something back into their communities. They'd like their children to continue the values that the parents have created through philanthropy. And these kinds of objectives can be combined with proper estate planning and life insurance, so that what we try to achieve is meeting the philanthropic goals, reducing taxes, because when you make a gift to a charity, you can get a donation tax credit, which I'll talk about in a moment, and utilizing insurance to fill the hole created by the gift. So if we look at a typical simplified freeze structure, the operating company has, Todd, you want to just expand the slide a bit? We can't see, that's it, thank you. Oh, no, go back, there we go, okay. Under the OPCO, you can see that, the entrepreneur with 10 million of pref shares uses the operating company funds to purchase life insurance, key person life insurance on the life of the entrepreneur, with the idea that that insurance will provide funding on death. And the entrepreneur, let's say, continuing to have voting control through common shares or another class of thin voting shares, which we talked about earlier, has 10 million of pref shares that are frozen. And let's say that the idea is that those pref shares are to be donated to charity. And if it's done through a will, it's a bequest. And so the charity can obtain the shares, but they're illiquid. So it doesn't really benefit the charity yet. It would be much better if the charity could convert the illiquid pref shares into cash. Well, that's where the life insurance comes in, because on death of the entrepreneur, the OPCO has received 10 million of cash in this simplified example, and the OPCO can use the 10 million to redeem the pref shares that were issued to the charity. That way, what we've achieved is a gift of 10 million on death and funding the charity with the 10 million of necessary cash to be able to redeem the shares. So now the 10 million of donated value can generate a tax credit at 50% rate of 5 million for the donated shares. And on the assumption that under the recently changed rules, the deceased estate is called a graduated rate estate, means there's a lot of flexibility in claiming the donation tax credit. It can be claimed in the terminal year of the entrepreneur, the year before, or the 3 years subsequent to that by the estate itself. And so the executors of the estate can get the benefit and look at the optimal use of that tax credit. And the end result is that we have, in the case of the charity, it could be a private family foundation, which is taken over by surviving family members after the entrepreneur dies. It could be in a public charity, an endowment fund, a donor advised endowment fund. For example, a lot of the banks have created public charities where families can consult with the members of the board of directors, say, of the public institution, to work out a strategy on how to invest and apply the funds in the endowment for charitable purposes. So there's a lot of flexibility in using either a private family foundation or a donor advised endowment fund in the charity. Both work well for this kind of structure. Todd, back to you.
Oh, thank you, Lorne. I think in summary for this slide, the important thing to realize is that a significant amount of wealth in Canada comes from privately held corporation shares and corporations. The other thing to consider, is there certain benefits of donating shares of public companies, and so far as you can qualify for these, very large tax credits. What we've demonstrated here is there's ways that you can effectively gain these same kinds of credits using shares of privately held corporations, in this case, preferred shares. We're going to do a very brief synopsis, and then we'll take some of the questions that we've had. So just by way of summary, again, we are seeing so many situations where no one's doing an estate freeze. Not no one. Many entrepreneurs are considering estate freezes or something they should do later. We've determined that you can maintain control of your company through an estate freeze. We've also been seeing situations where there's U.S. property that is not properly shielded from U.S. estate taxes. There's solutions. We see situations with U.S. corporations where exempt surplus can be moved tax-free into Canada if it's done properly, but not through the expense of loss of capital gains exemptions. We've seen this issue with active and non-active property being commingled. We've described structures for you, and there's many others we could show you. And this is series one, or part one of this series on how to utilize funds from corporations. There's many more issues we'll be talking about at future events, but in today's session, we're really talking about a way of, again, keeping your active assets to the left, non-active to the right. Very important from the point of view of tax benefits as well as asset protection. We've also talked a little bit about the use of well-known tools that are used. We look at all of these as important tools, just like an estate freeze or a trust is a tool. Well, so is life insurance. It has a place, and if it's used correctly, there can be incredible benefits there. Benefits to existing shareholders, future generations, benefits to being able to access funds without tax consequences that are so severe. And also, as far as charitable giving, these are all things that we believe are often overlooked. And that's what I like to think our program is designed to do, to provide lawyers, accountants, and business owners with the tools to bring sophisticated tax planning for the benefit of business owners. And business owners who are in attendance, we're always very happy to work with you and make sure that you understand directly what the issues are. That being said, I believe we have a few questions here. Perhaps not. I think.
Yeah, we do have some questions here, so I can read them out to you, Todd. It's not a problem.
Oh, sure.
So the first question was from Nigel. He was asking about the $1 million shareholder loan that we had recommended earlier. He was asking if it's taken into income at the end of the second year, if the interest rate on the loan is market rate, and if that's the case, it seems counterintuitive. Does anyone just have an answer to that question?
Yeah, can I take a shot at that one?
Yeah.
Because I brought up the topic.
Yeah.
And Nigel, that's a great question, and it is counterintuitive. But the fact is that if you have a loan from a company to a shareholder, even if you pay a market rate of interest on it, you're still considered to have received a benefit if you don't pay it within the time limit imposed by the specific section is 15.2.6. So you have to be careful with that. So number one, remember that when you do have this loan, you do have to pay interest during that 1 year period. And that is a loan that's a prescribed rate interest loan. And the regulations to the Income Tax Act have a specific rate that applies to that. And you have to pay that on a monthly basis. So not only do you have to get this, repay it within that 1 year, but during that 1 year period of time, you have to pay monthly prescribed rate interest. If you don't do it, and I know a lot of people say, gee, shucks, I don't have to do that. I'm not going to be bothered with the prescribed rate interest. If ever you're the subject of a compliance review by the agency, Canada Revenue Agency, and that comes to light, a knowledgeable assessor or auditor is going to take issue with the validity of the loan. And even if you try and repay it at that time, and you repay it within the allotted time, you may still run into an issue. So, number one, paying interest does not get you out of that 1 year rule. Number two, do pay interest at the prescribed rate at the right times. And Nigel, if you need to, you can always reach out to me. You have my number, and I'll be happy to discuss it more.
Let me add one
Thank
point to what Diane has said. We need to look at this loan in two different ways. One is the use of a corporate asset, and you have to pay for that, and that's where the interest obligation comes in that Diane has mentioned. But the underlying tax policy on loans to shareholders is these are equivalent to distributions of surplus. And that ought to be taxable as either ordinary income or as a dividend from a taxable Canadian corporation, but it is in the form of a distribution. And unless it's paid within the prescribed time, within 1 year after the end of the year in which the loan is made, it will be taxed as a distribution, separate and apart from whether there's a commercial quality to the loan and the use of a corporate asset. So both things have to be kept in mind. It's not really counterintuitive because there are two policy objectives here that we have to keep in mind.
There are some other, just to add to that, some exclusions that deal with instances where a shareholder would utilize the funds for habitation purposes, but these are very narrow. This isn't something that can be depended upon. There's also issues there with respect to the type of employment and whether or not the benefit that the person's receiving as an employee of the company or quasi-employee would be one that one would expect in different circumstances if they were employed, say, by an arm's length individual. This is not an area that we can just, think about in terms of, whether it makes sense or it doesn't. It is the law. It is something that CRA enforces. So before they come knocking, if you have these loans, call us and we'd be happy to help. Jordan, do we have any more questions?
Yes, there's one more question from Lorne asking, at what point in corporate value investment/revenue does it make sense for a company to seek your help in setting up holdcos and opcos?
Yeah, so I'll maybe take a run at that one, and we'll have the rest of the panelists answer it as well. I'll start it out and then we'll go around in a circle here. Okay. At what point? Well, I'm going to say that if it's clear that the company is going to be growing exponentially, at the very beginning is the time to structure it properly. There can be provisions that are put in place that can provide for conduits that would allow you to be able to distribute surplus outside of a corporation, avoiding all of the dilemmas that we're seeing in so many corporate structures, and also introducing family members as shareholders. Maybe we'll go around here, John?
Okay, John, you go ahead.
My only comment would be no harm, no foul, not expensive, so worth doing and considering and thinking through.
Yeah.
So I would engage one of you august tax professionals early in the game.
So let me jump in here at this point, give an example of how doing it at the beginning can be tremendously beneficial. A few years ago, I was approached by a group within a bank that wanted to break off and form their own financial institution. A number of the partners wanted to create a tax efficient structure. And so what we did was we set up a partnership. Actually, there were several underlying business partnerships, but at the top ownership level, at the beginning, we did an estate freeze for each partner. So there was a corporation that was putting the partner's funds into the partnership. It was a frozen corporation so that the partner had fixed value shares, and then a trust was set up to own the common shares of each of the capital corporations for the benefit of the respective families. So we had maybe a dozen different corporations with each having its own trust, and they owned interests in these partnerships. And the idea was, or the plan was, after a period of time, let's say 5 years out, if this financial institution would grow the way the partners hoped it would, there'd be an initial public offering, or there would be a sale to a strategic purchaser, and there'd be big capital gains. Well, that's exactly what happened. About 5 years out, there was a sale to another large institution, and capital gains were realized by the trusts. And in one family, I remember a very fruitful family, husband, wife, 4 children, 6 lifetime capital gains exemptions were available to offset the capital gains that were realized. And all of that was very well planned and executed from day one. The freeze structures were appropriate. Now, it's not going to be appropriate in every case, but I give that as an example where there was a home run resulting from proper planning.
Great. Thank you, Lorne. Diane, when is the best time for a company to look at doing this sort of planning? At what stage, in your opinion?
I agree with everybody here. I think what's been my experience is much like Lorne's, is if you anticipate some major event, get it done now. And the really key thing is, and I think this is the most important one, is to pick up the phone and call somebody knowledgeable and ask them what they think, because they're in the best position to help you have a chat about it and tell you whether or not this makes sense at this particular time.
I'll just answer a question that someone had presented recently, and that was, at what point do we look at trying to create tax effectiveness to handle certain corporate expenses? And maybe just in closing, since we are scheduled to close at 1:15 with our questions, maybe we'll answer that question now. Just
Great.
wondering, yeah,
There's actually one more question just from Almanir, actually.
okay.
They were asking, what is the rate of an acceptable guarantee fee? Would 1/4% be reasonable?
Maybe Diane, I have you answer that question in reference to this guarantor fee for the insurance, and then we'll close off with the slide.
I'll be quick. Typically, I've seen them run between 1% and 2%. We got a report commission that says between 1 and 2. I've seen them as low as 1/4, by the way. What the CRA will really look for, to be honest with you, is that you've made an effort to have a guarantee arrangement in place and to pay a fee. I think 1/4% might be a little light. I would be, Lorne, you have any thoughts on this? I would say between 1, 1 1/4, 1 1/2. And remember, if you're investing those funds to earn income from property or from a business, that fee should be deductible.
I'll just
Lorne, any thoughts?
briefly comment on that. The test is going to be, what would the party receiving the benefit of the guarantee deal with on an arm's length basis? So if the guarantor would be required arm's length to pay 2%, that should be 2% because it's a higher risk. If, on the other hand, there's a very low risk, it may be possible to do it at 1 or less than 1, but I'd be very cautious about reducing the rate below 1%.
So thank you very much. So in closing, we're going to just leave this thought with you. We've had questions from individuals. How else can we create additional tax effectiveness for some of the planning that we're doing? And this is a solution that's called a captive insurance strategy. Essentially, it's designed for companies who pay significant insurance premiums and have pretty good claims control in place. In effect, what we're able to do is we're able to set up what's called a captive insurance company. Sometimes it's a collective undertaking, which we call a group captive arrangement, that can provide insurance such as, property casualty insurance, issues involving certain types of liability that are rather difficult to cover. And in some cases, there's significant reduction in insurance premiums. And our group has been involved in this kind of planning quite extensively. And there's also some opportunity, in some cases, for foreign risks. Say, as an example, you have a company that operates both in Canada and in the USA. Well, for US risks to come under this umbrella in a fashion that you're able to, in some cases, bring profits back to Canada without any tax, to what's called exempt surplus. Perhaps I'd have maybe just our group comment very briefly, and we'll do a deeper dive into this area next time. Maybe a comment on this structure and how it applies and what the bottom line benefit is from each of our panelists. Lorne?
Well, A captive insurance company is licensed in a tax benefited jurisdiction such as a Barbados or a Bermuda. And if then that foreign owned company goes into the international reinsurance market and is able to buy insurance wholesale, the overall benefit is a saving of 20% to 30% in our experience of what the premium costs would be if the same risks were insured through a typical retail insurance provider. Cost saving is the first prime benefit of this. Organizing and managing risk is the second. And if it can be structured to insure non-Canadian risks, it's possible to get significant tax deferral, and as Todd mentioned, even possible to get tax-free dividends through exempt surplus coming back to Canada. If it's Canadian risks, we don't get the same benefits, but we can get the same cost savings and management of risk.
Yep. John?
I could just comment, captives have been around for as long as I can remember, 40 years plus, and every major Canadian corporation that has risks, either domestic or international, primarily international, has its own captive insurance company. It's a licensed real captive insurance company, and that would be a single parent captive. But the big trend in the last few years is to use a captive insurance structure as a wealth creation technique for the family. So if the family has, one or two or three operating businesses which have insurance needs, and they would be interested in quietly capturing the underwriting profits from those businesses over the years by transferring the risk, by assuming part of the risk, obviously, in the captive insurance company, but also transferring a part of the risk to the reinsurance market, which, as Lorne said, is a wholesale market versus a retail market.
So we're talking about self-insuring for a small percentage and sending the rest to reinsurance, which would assume additional risk over a threshold. Closing comments on captives, Diane?
No, I agree with everything that's been said to this point.
Excellent. Well, without further ado, it is just after our closing time, so we'd like to thank everyone very much for attending our program. We will be issuing new invitations to part 2 of this series, dealing with how to utilize corporate assets tax effectively. Thank you very much for your attendance, and we hope everyone has a very pleasant Tuesday afternoon.
Thank you.
Thank you.